Artificial intelligence stocks will continue to outperform the market in the near future. Billy Bob here, and I have my co-host Sarah with me. Today we're breaking down one of the hottest names in AI infrastructure, Astera Labs, ticker ALAB. The stock is up over 84% year to date, trading right around $307, and investors are asking, is there more room to run, or is it time to take profits? All right, let's get into it. First things first. For viewers who might be hearing about Astera Labs for the first time, what exactly does this company do? To help us navigate this, we've got our lead market analyst, Sarah. Sarah, welcome.
Thanks, Billy Bob. Great to be here. Astera Labs is a high volatility stock, beta of 3.35. At its core, Astera Labs builds the plumbing for AI data centers. Think of it this way. When companies like NVIDIA build powerful AI chips, those chips need to talk to each other and to memory and storage at incredible speeds. If that connection is slow or unreliable, the whole AI system underperforms. ALAB's intelligent connectivity platform solves that problem. They make semiconductor-based solutions that ensure data moves seamlessly across AI racks. Their flagship products include Aries, PCIe retimers that clean up signals over longer distances. Scorpio, fabric switches that connect dozens of GPUs in a scale-up architecture. This is their big growth driver for 2026. Leo, CXL memory controllers that let AI systems pool memory more efficiently. Cosmos, their software suite that gives data center operators visibility and control over all this hardware. They're fabless. They design the chips, TSMC manufactures them, and they sell directly to hyperscalers like AWS, Azure, and Google, as well as to AI accelerator vendors. Revenue in Q1 2026 was $308 million, up 93% year over year. So they're not just a story, they're executing at scale.
So they're like the traffic cops for AI data, making sure everything flows without congestion. And with AI spending exploding, that's a pretty sweet spot to be in. But Sarah, we developed a thesis framework earlier. Bull, bear, and neutral cases. Can you walk our viewers through that quickly?
Absolutely. Let's keep this crisp. The bull case rests on 4 pillars. Structural tailwind. AI rack scale connectivity is a bottleneck, and ALAB is a pure play beneficiary. Their Scorpio X-Series fabric switch targets a $20 billion market by 2030. Product mix upgrade. They're moving from $50 to $100 retimers to thousands of dollars per rack fabric switches. Massive content per rack expansion. First mover advantage. They're shipping PCIe 6.0 solutions 12 to 18 months ahead of larger competitors. That's a real moat in semiconductors. Profitability at scale, non-GAAP operating margins of 36% while still growing revenue 93%. That's rare and powerful. The bear case highlights 3 key risks. Valuation stretch. Forward PE over 100 times. Enterprise value to sales, or EV to sales, around 13 to 15 times. That prices in perfection. Customer concentration. Over 50% of revenue comes from just 3 customers. If one hyperscaler shifts strategy, it hurts. Competitive response. Broadcom and Marvell aren't sitting still. They have deeper pockets and can bundle connectivity with broader portfolios. The neutral case is for investors who own the stock at lower prices. Hold, let winners run, but don't chase here. Wait for either a technical pullback or clearer confirmation of the Scorpio X-Series ramp in H2 2026.
So Bull says AI infrastructure is just getting started. Bear says the stock's priced for a miracle. And neutral says, I'll wait and watch. Got it. Now, Sarah, we also ran that comprehensive 6-part analysis framework. Can you give viewers the highlights, especially the business phase and Moat Assessment?
Let's walk through the key outputs, Billy Bob. Analysis 1, business phase. We use a strict decision tree. No dividends to positive operating income to revenue growth greater than 20%. ALAB checks all boxes. $61.8 million. GAAP operating income. 93% revenue growth. That puts them squarely in phase 3. Hypergrowth. This matters because it tells us which metrics and valuation tools to prioritize later. Analysis 2 and 3, business model and moat. Their model is fabless semiconductor sales with increasing software attach. The Moat Assessment shows switching costs, moderate to high. Cosmos software creates workflow lock-in. Intangible assets, high, 200 plus patents. PCIe 6.0 first mover status. Counter positioning, high, pure play focus versus diversified giants. Overall moat size, medium, but widening as they deepen technical leadership. Analysis 4, growth drivers. The strongest drivers are new products, Scorpio X-Series ramp in H2 2026. Volume leverage, existing hyperscaler relationships scaling production, new use cases, CXL memory pooling, confidential computing, pricing power remains a yellow flag, hyperscalers negotiate hard. Analysis 5, phase-specific metrics, health check. For a phase 3 hypergrowth company, we look at revenue growth 93% to green, gross margin stability 76.3% to green, operating leverage, OPEX grew 60% versus revenue 93% green. Customer concentration, top 3 greater than 50% leads to yellow circle. Cash flow conversion, slight lag due to receivables build leads to yellow. Overall, mostly green with yellow watch items. Execution is strong, but concentration risk is real. Analysis 6, Valuation Framework. For Phase 3, we prioritize enterprise value, or EV, to forward sales and PEG ratios over trailing PE. Current forward sales multiple, approximately 13 to 15 times. That's a premium, but justified if growth sustains above 50% for the next 2 to 3 years.
So the fundamentals look strong, the moat is real but not unassailable, and the growth engines are firing. But Sarah, here's where viewers are probably scratching their heads. The analyst consensus price targets are below the current stock price, and that DCF model from Simply Wall Street shows a fair value of just $91. How do we reconcile that?
This is the million-dollar question, Billy Bob. Let's break it down. Analyst consensus. Average price target across 23 analysts, approximately $204 to $244. That implies 20 to 33% downside from $307. But, and this is critical, 100% of EPS estimate revisions over the last 60 days have been upward. Analysts are raising their earnings forecasts sharply while keeping price targets cautious. Why? They're betting on growth momentum, but worried about valuation multiples compressing. Simply Wall Street DCF model. Fair value estimate, $91.29. Implied overvaluation, plus 236%. Valuation score, 0 out of 6. This model discounts future cash flows at a risk-adjusted rate. It's telling us, if growth normalizes, if margins face pressure, if competition intensifies, the present value of those cash flows is much lower than today's price. Why the gap? Time horizon. Analyst targets are 12-month tactical calls. DCF is a long-term intrinsic value estimate. Optionality premium. The market may be pricing ALAB's leadership in PCIe 6.0/CXL as a call option on AI infrastructure dominance, hard to capture in a DCF. Sentiment and liquidity. AI momentum, low float, and institutional buying can sustain premiums disconnected from fundamentals in the near term. In short, analysts are asking, where can the stock go in 12 months given current momentum? The DCF is asking, what is this business worth if growth mean reverts? Both are valid. They're just answering different questions.
So it's not that one is right and the other wrong. It's about perspective. Okay, Sarah, bottom line time. Our viewers want to know, based on everything we've discussed, the thesis, the methodical analysis, the valuation disconnect, what should they do with ALAB?
Let's be clear and actionable, Billy Bob. There's no one-size-fits-all answer. It depends on your profile. If you're a momentum trader or already own ALAB at a lower cost basis, hold or add on technical pullbacks. Wait for a retest of the 50-day moving average, approximately $270 to $280 with supportive volume. Use tight stop losses. This is a high beta stock. Manage risk. If you're a long-term growth investor with high risk tolerance, consider a small satellite position, less than 5% of portfolio. The bull case is compelling if you believe AI rack scale optimization is a multi-year theme and ALAB maintains its tech lead. But size it appropriately. This is not a core holding at current multiples. If you're valuation sensitive or risk averse, do nothing or wait. The DCF gap and analyst price targets suggest limited margin of safety. Wait for either A significant pullback, greater than 20%, to improve entry valuation. Or B, clear confirmation of Scorpio X-Series volume ramps and customer diversification in H2 2026. If you're looking for income or capital preservation, avoid. No dividend, high volatility, and customer concentration make this unsuitable for conservative portfolios. One final technical note for our CMT viewers. Watch the $280 to $290 support zone. A break below on rising volume could signal distribution. Conversely, a decisive break above $315 52-week high with volume could fuel the next leg up.
Powerful insights, Sarah. So to recap for our viewers, Astera Labs is a hypergrowth AI infrastructure play with real products, real revenue, and real momentum. The bull case is strong, but the valuation is stretched. Your action depends on your strategy. Momentum traders can work it. Long-term growers can size small. Value investors should wait. And always, always manage your risk. Sarah, thanks for breaking this down so clearly.
My pleasure, Billy Bob. Remember, do your homework, know your risk tolerance, and never invest more than you can afford to lose.
Well said. All right, that's our analysis today. If you found this helpful, give us a thumbs up, drop your questions in the comments, and subscribe for more deep dives. We'll see you next time. Keep building and compounding that wealth. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.